Chair is authorized to declare a recess of the committee at any time. This hearing is entitled How Mandates Like ESG Distort Markets and Drive Up Costs for Insurance and Housing. Without objection, all members will have 5 legislative days within which to submit materials to the chair for inclusion in the record. I now recognize myself. The subcommittee has convened today for a hearing entitled How Mandates Like ESG Distort Markets and Drive Up Costs for Housing and Insurance. This hearing is part of the committee's continuing work this month to investigate the far-reaching impacts of a new trend in the financial services world: forced government ESG mandates. For those who are not familiar with it, ESG is the latest progressive buzzword for environmental, social governance factors. ESG is a form of virtual signaling where companies can proclaim how enlightened they are based on their environmental, social, or corporate governance actions, even if they have to ignore their fiduciary duty to their stakeholders or decrease the value of their goods and services to consumers. Those that give into ESG movement think that it will make their company more popular with progressive agitators and investment companies. Those that don't give in are pilloried and protested for having the audacity to focus their business on their business. Essentially, ESG is in many cases a modern shakedown tool brought to you by today's cancel culture. Now, some might say, what's wrong with a company becoming more involved in environmental, social, or corporate governance issues and telling their customers about its values? The problem becomes when ESG is not being offered as a choice, but as a mandate. ESG mandates, like so many other government mandates before it, are always offered up as harmless tweaks on the path towards social enlightenment, free from cost or ill intent. That will make the markets work better. Of course, the reality is the exact opposite. Mandates like ESG distort markets, drive up costs of products, reduce consumer options, create scarcity, and misalign investment capital. Made-up metrics like ESG scorecards are created to determine which companies are in the good graces of left-wing activists. These modern-day social credit systems drive a wedge within open markets by directing investments to companies that satisfy progressive demands. Your company's access to capital should not be dependent on being more woke than your competitors. The far left shouldn't be able to cancel your business because you don't comply. ESG scores and mandates create social credit system that makes life harder for American consumers, businesses, and retirees with little or no discernible benefits. So today's hearing will explore the impact of growing ESG movement on 2 different industries, housing and insurance, and what it means to the consumers. Because ultimately, that's the job of government regulators, to protect customers from collusion and from fair practicing. With that, I would like to yield 1 minute to my colleague, Mr. Huizinga.
Well, thank you, Madam Chair. I appreciate the opportunity to address this subcommittee. Last year, the Supreme Court ruled in West Virginia versus EPA that government bureaucracies cannot arbitrarily expand their own regulatory reach outside of the legal process. This new form of regulatory activism ignores reality, forcing American companies to defend themselves against regulations and rules that are immaterial to their business model. The The rush to implement ESG policies in housing and insurance will come at a price, leaving taxpayers and our constituents with fewer choices and higher costs. Republicans will continue to defend capitalism as Democrats continue to push their far-left ideology on the American people through the regulatory process. And I appreciate you allowing me to wave on to the committee, and with that, I yield back.
I yield back. The chair now recognizes ranking member of the Subcommittee on Housing and Insurance, the gentleman from Missouri, Representative Cleaver, for 5 minutes for an opening statement.
Thank you, Madam Chair. The title of today's hearing is How Mandates Like ESG Distort Markets and Drive Up Costs for Insurance and Housing. A mandate, by definition, is a statute, law, rule, regulation, code, or ordinance duly adopted by any government authority. In the United States, as in most nations, we have different levels of government and different branches of government and mandates at each level. No mandate is the same. Mandates have costs, have benefits, which must be debated on their individual merits. Each of the witnesses with us today, based on what I've seen in their testimony, has their own mandates to discuss, and I would hope that this hearing will take on a clear focus by the end. But let me just say this. In terms of cost, I am very concerned about the severe financial and non-financial costs for failures to adequately address environmental, social, and governance concerns. The best things in life are not always free. Nature also has some mandates, and that we're going to have to deal with it whether we want to or not. In recent years, we've seen frequent and severe natural disasters in the United States, including hurricanes, wildfires, floods due to climate change. An increase in people living in high-risk areas such as coastal areas vulnerable to severe storms and flooding have worsened the impact of these events. Low and moderate income and minority households are disproportionately exposed to risks due in large part to historical discrimination and underinvestment in infrastructure in their communities. This is the most material impact on insurance costs. And according to FEMA, roughly 2/3 of communities facing hazardous risk have not yet adopted hazardous resistant building codes, which, if adopted in all future construction, would avoid more than $600 billion in cumulative losses from floods, insurance, paying out large amounts of money. In addition, current energy codes extend habitability during these weather-induced incidents by as much as 120% during extreme cold and up to 140% during extreme heat, while reducing deaths by 80% and 30% respectively. Communities that regularly adopt modern energy codes also save money for residents and businesses and improve community health and resilience. 13% of U.S. households are now severely energy burdened and paying more than 10% of their income on energy. The crisis of insurance costs is not ESG mandates, but just the opposite. There are significant costs for failing to implement ESG mandates that are passed on to others and pushed off to be paid at another time. And the ESG mandates will continue to be irreplaceable in reducing risk that drives cost and improving the resiliency of current and future housing stock with an eye toward affordability and racial equity. Democrats are leading the way on this issue that we are required to address. We went through and approved the Infrastructure and Investment and Jobs Act, as well as the Inflation Reduction Act, to help industry and local governments better address the underlying issues. In housing, social considerations were ignored and discriminatory zoning known to increase the cost of housing development and drive both economic and racial segregation have flourished. Democrats are leading the way on these solutions, as well as through the Housing Supply and Affordability Act, the Yes in My Backyard Act, My American Housing and Economic Mobility Act, and several pieces of legislation put forward by Ranking Member Waters. But the reality is that while reducing barriers is essential to fixing the supply problem, it will not be enough to address market failures. Even with common sense regulatory reforms, builders cannot deliver low enough rents without subsidy and robust government support for housing that must be built with a long-term aim at being able to withstand the environments they are built in. I hope that we can have a good discussion today rather than denying the importance of ESG mandates, but to actually discuss how we can best move forward with ESG concerns in a sensible way. Madam Chair, I would like very much for a moment of personal privilege.
Without objection.
Thank you very kindly. I've been here on this committee for almost 19 years, and we've had a lot of people who have been here with us, which those people have made the committee work, made the committee actually function, both on the Republican and Democratic side. And from time to time, we have to say goodbye to some of our staff members. And today, Franklin Thornton is having his last day with the committee. He's been here for a while. And many of us will remember all during the COVID crisis, he was the first face we saw every morning, for good or bad. But he was there and gave us great comfort. He made sure that everyone was connected during a very turbulent time in our country. And so I just wanted to express on behalf of all of us our appreciation for his work, and it may be of some importance to his mom and grandmother to know that your offspring has been very good to us. Thank you very kindly, Madam Chair.
Thank you for your service. Today, we welcome the testimony of Mr. Bill Bohr. Mr. Bohr is the president and CEO of Cavco Industries. We also welcome Ms. Alicia Huey. Ms. Huey is the chairman of the National Association of Home Builders and the president of AGH Homes, Inc. We also welcome Mr. Jerry Theodoro. Mr. Theodoro is the Director of Finance, Insurance, and Trade Policy Program at the R Street Institute. And of course, we also welcome Ms. Caroline Nagy. Ms. Nagy is the Senior Policy Counsel for Housing, Corporate Power, and Climate Justice at Americans for Financial Reform. We thank you for taking the time to be here today. You will be recognized for 5 minutes to give your oral presentation of your testimony. Without objection, your written statements will be part of the record. Mr. Bohr, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Madam Chair Dela Cruz, Ranking Member Cleaver, and members of the subcommittee for the opportunity to testify today. My name again is Bill Bohr. I'm the CEO of Cavco Industries, the 3rd largest U.S. producer of factory-built homes. Last year, we delivered over 19,000 homes to deserving families. Today, I'm testifying on behalf of the Manufactured Housing Institute, where I'm the vice chair. With regard to ESG, good companies understand that considering all stakeholders, including the environment, is good business. The challenge lies in the trade-offs and the execution. Narrowly considered mandates and regulations which are only focused on one aspect of ESG often result in unintended consequences. While well-intended, it's undeniable that a lack of broad perspective in these mandates can get in the way of companies being able to move the ball forward on environmental and social improvements, while at the same time creating jobs, building the economy, and delivering solutions to problems such as affordable housing. I want to discuss an example of a well-intended regulatory mandate that, if allowed to proceed as proposed, will directly hurt those who are on the cusp of affording a home. This is the energy efficiency standard being imposed by the Department of Energy, which will drive up costs of manufactured homes without achieving the DOE's energy objective. And the question is not just one of whether there is a return on the added upfront cost, but whether the prospective homeowner can even afford the cost at all. Based on studies of price sensitivity, if the added costs of the DOE rules are conservatively estimated at $6,000, over 900,000 households are priced out of home ownership. So the trade-offs and consequences are very real. I want to emphasize that I'm proud of the manufactured housing industry's record. By virtue of our controlled and efficient processes, we're inherently more environmentally friendly than other sources of housing. We have a long history of consistent and ongoing quality and energy improvements, and we have a strong and positive working relationship with our regulator, HUD. This is an industry that agrees with the objective of continuing to improve energy efficiency, not one that needs to be dragged to do the right thing. As a result of what I view as a legislative misstep, we now face two regulators with overlapping but different mandates. HUD is expected to provide one set of federal standards considering product safety, quality, cost, and the objective of increasing affordable housing. However, as a result of an unvetted rider in 2007, the DOE is now separately seeking to singularly drive energy efficiency with disastrous consequences for lower-income families. Briefly, the DOE rule holds manufactured housing to more stringent standards than other forms of construction. It significantly underestimates the burden placed on lower-income home buyers, and it's impractical given our unique manufacturing and transportation processes. The DOE's execution of their mandate has many problems, but fundamentally the process and what they have been asked to do is flawed. Fortunately, it could be readily corrected with HR 3327. Clarifying HUD as the sole regulator and requiring DOE energy mandates to be worked through the established HUD process does not stop our path on energy efficiency. It requires this one objective to be considered through an already established holistic process. Back to the subcommittee's topic, this is a microcosm of the ESG challenge. Well-intended but myopic attempts to regulate singular topics are bound to mislead if they're not subjected to a holistic evaluation. There are many other ESG-related topics I'd like to cover, but I know my time is limited. For example, there's a role for the federal government to eliminate zoning barriers that prejudicially preclude our homes from needed areas. We're not looking for advantages, just an even playing field where we can compete with quality, lower-cost homes. The central point I'd like to make is that providing affordable homes is an incredibly important social need that manufactured housing is uniquely positioned to serve. Factory-built housing is the least expensive form of unsubsidized home ownership. Enable us to do good work in responsible ways. We can dramatically increase affordable housing while modeling corporate responsibility if singularly focused ESG regulations are worked through established holistic processes. Thank you.
Thank you. Ms. Huey, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Madam Chairman, Chairwoman Dela Cruz, and Ranking Member Cleaver, and members of the subcommittee. I am pleased to appear before you today on behalf of the National Association of Home Builders to share our views on how burdensome regulation and mandates promoted by government support for environmental, social, and corporate governance policies impact our industry's ability to increase the production of quality, affordable housing. My name is Alicia Huey. I am NAHB's 2023 Chairman of the Board and a custom home builder from Birmingham, Alabama. NAHB's typical member builds 10 or fewer homes per year and are small businesses, so most of us are not directly impacted by ESG investing decisions. However, as ESG considerations are given more credence in various approaches to address climate change and other social issues, they are becoming increasingly relied upon to justify regulatory actions. As a result, government support of ESG policies is more and more likely to impact housing production and affordability. As the ESG debate moves forward in this country, NAHB members are increasingly concerned about the far-reaching impacts and how we will be challenged to comply. ESG policies have already caused insurance companies to drop out in some areas and raise rates in others. Lenders are being urged to minimize the risk associated with their portfolios and may cease lending in certain locations or increase their borrowing rates. Likewise, small businesses doing business with publicly traded companies may be required to provide their ESG risk data to those larger companies. As supply chain woes continue to stifle residential construction projects across the nation, we worry that ESG disclosure requirements could further impede or prevent availability of the needed building supplies. And finally, we are concerned that over-reliance on ESG factors often ignores the central tenets of consumer choice, market needs, and project feasibility, which are key considerations for home builders. Like myself, NEHB members live in the communities in which they build. We are stewards of the environment, hire local workers, provide housing at a diversity of price points, run our businesses in responsible ways, and make positive contributions to the social and economic fabrics of our towns. However, government regulations continue to make it more difficult to provide an affordable housing product to our customers. Residential construction is one of the most heavily regulated industries in the country. To emphasize the impact of this regulation burden, NHB recently did a study that shows that approximately 24% of the price of a newly built single-family home is due to the broad set of regulatory burdens imposed by the local, state, and federal governments. On the multifamily side, up to 41% of apartment development costs are due to regulations. Many actions have been taken over the past few years to insert ESG considerations into federal policies and regulations that add more uncertainty, delays, and costs to the home building process and negatively impact the housing affordability. These include recent legislation that issues the lure of federal dollars to pressure state and local governments to adapt costly and restrictive energy codes, a growing effort in communities to cite ESG policies to gain support for laws and ordinances that ban the use of natural gas and propane within new construction and existing homes, greatly limiting consumer choice. A push by the Department of Energy to increase energy efficiency standards for electrical distribution transformers during a time when a historic backlog of hampering development across the country. Continuing regulatory uncertainty surrounding the most recent Waters of the U.S. ruling under the Clean Water Act, a recent decision by FEMA in California to suspend a critically important floodplain mapping program that will result in homebuyers needlessly having to purchase flood insurance. Proposals being considered by federal agencies that will have the unintended consequence of discouraging private sector participation in rental markets. Finally, I've highlighted already a growing insurance crisis made worse by perceived risk and pressures to address ESG that is making it more difficult for both existing and potential new homeowners to secure available and affordable insurance and is impacting development of affordable rental housing. Thank you again for this opportunity, and I look forward to working with all of you.
Thank you. Mr. Theodoro, you are now recognized for 5 minutes to give your oral remarks.
Vice Chair De La Cruz, Ranking Member Cleaver, Chairman Davidson, esteemed members of the subcommittee, thank you for holding today's hearing and for the invitation to testify. My name is Jerry Theodoro. I lead the R Street Institute's Finance, Insurance, and Trade program. My focus at R Street is analysis of the property and casualty insurance industry. My research, publications, public presentations, and congressional testimony have focused on drivers of insurer performance and the impact of market and external factors on insurers, policyholders, and the economy. Today's hearing is timely because environmental, social, and governance factors can influence insurers' performance, and by extension, the availability and cost of insurance for consumers and businesses. Government mandates impacting the insurance industry, including ESG mandates, can distort insurance markets, leading to less cost and higher costs, less choice and higher costs for insurance buyers. Examples of the ways that government or regulatory mandates can distort insurance markets include monopolies for certain insurance products and intervention in how insurers may calculate their rates. For example, workers' compensation insurance is provided by a state-run monopoly in 4 states: Ohio, North Dakota, Washington, and Wyoming. The absence of private insurers there deprives employers from product choice in such a non-competitive market. In North Carolina, a rate bureau promulgates insurance rates. The state's rate bureau has been compared to a cartel because insurance companies set and use the bureau rates, depriving customers, buyers of insurance of choice. In California, regulatory overreach has disrupted the insurance market in 3 ways. By prohibiting insurers from incorporating reinsurance cost into rate making, by prohibiting insurers from factoring current weather trends into rate calculations, and by allowing interveners to challenge rate change requests with the implementation of the intervener process intransparent. As a result, many national insurers are curtailing their California insurance business. ESG mandates can also impact the availability and cost of insurance if insurers are barred from insuring certain energy risks. Because power plants cannot operate without insurance, they will find coverage outside the standard market, from Lloyd's or from the surplus insurance marketplace where costs are generally higher. ESG mandates can also adversely impact the insurance industry's large investment portfolio. The property and casualty industry holds $1.2 trillion in bonds. Life insurers hold an additional $3.4 trillion in bonds. This is nearly 10% of the aggregate $51 trillion US bond market. If ESG mandates compel or prohibit investment in certain issues, insurers' investment income can be compromised, leading to higher insurance rates to meet shareholder return expectations. The core activity of insurers is to allocate capital to risk. Premiums reflect risk magnitude. Past losses and claims payments are signals that inform insurers about risk. If government bodies mandate rating factors that insurance companies may or may not incorporate into pricing, rate is decoupled from risk, and the market is disrupted. If insurers are coerced to price policies without regard for risk magnitude, they will abandon markets. So if ESG is mandated with the government replacing the judgment of the private sector, it has deleterious impacts. But if it's private sector driven, it can be a useful tool in the toolkit. Mandates impacting insurers' coverage, price, or investment decisions render insurers less able to fulfill their 3 critical roles in the economy. And these are paying for claims from disasters and other losses, enabling businesses to take on risks that they would not otherwise take, and buying municipal, government, and corporate bonds to support our nation's infrastructure and to satisfy America's need for capital, corporate America. Because the insurance industry plays such a vital role in the economy, mandates that may disrupt the industry deserve serious consideration. Exploration of the impact of ESG on insurers is therefore a timely and important undertaking. Thank you for having this hearing, and thank you for listening to my views. I look forward to your questions.
Thank you. Ms. Nagy, you are now recognized for 5 minutes to give your oral report.
Thank you. Vice Chair De La Cruz, Ranking Member Cleaver, and members of the subcommittee, thank you for the opportunity to present testimony on behalf of Americans for Financial Reform. We are a nonprofit working to lay the foundation for a strong, stable, and ethical financial system, one that serves the economy and the nation as a whole. Our housing and climate change crises are taking a tremendous toll on everyday working people. Following years of heavy losses from climate-exacerbated natural disasters, insurers and states across the country are raising rates and pulling out of markets altogether. Just this week, Farmers Insurance announced that it will pull out of Florida. In Louisiana, 11 insurers have gone bankrupt in the last 2 years and 10 have left the state. And this is just the beginning. This problem will continue to grow worse each year, each decade, until the climate crisis is mitigated. This hearing also comes at a time of unprecedented housing unaffordability and homelessness. In 2021, the number of tenants with unaffordable rents reached an all-time high, with 49% of US renters paying more than a third of their income on rent. Although homeownership is still a goal for many, it is increasingly unattainable when high rents hamper the ability to save for a down payment and home prices continue their meteoric ascent. In terms of factors influencing insurance prices, with the exception of the National Flood Insurance Program, insurance is regulated at the state level, and our states are home to a broad diversity of political viewpoints. Some, like California, have adopted more stringent consumer protections, such as procedural limits on rate increases, while other states, like Florida, have passed anti-ESG laws. Yet, Insurers are raising rates and withdrawing coverage in both of these states, which indicates that ESG is not the main driver of insurance unaffordability. So what then is behind these price increases? First, obviously, climate change is contributing to increasingly frequent and severe natural disasters. This is translated into massive, often unsustainable losses for insurers. Climate change is, in effect, upending the risk calculus that our insurance system has been based on. Second, reinsurance rates for catastrophic property coverage have greatly increased in recent years. July reinsurance renewal costs have increased, that's this July, by 30 to 50% for some US policies. The reinsurance market is global and unregulated, meaning that we have little to no control over their rates or what they do. Third, unsustainable land use practices. Too many states and localities continue to permit or even encourage new housing construction in disaster-prone areas. These problems are obviously very complex, and there is no one simple solution. This really requires many agencies and levels of government acting in tandem to truly meet this challenge. First, we need to support climate financial regulatory efforts. Financial regulators and institutions must manage and mitigate climate financial risks. Many lenders and insurers are contributing to the climate crisis by internalizing short-term profits through their investments in risky, carbon-intensive industries, while externalizing the costs onto their consumers and ultimately withdrawing when the physical climate risks get too high. We must also improve insurance data collection. Right now, we don't even have access to the data necessary to understand insurance trends on a national level, which is why we support the Federal Insurance Office's limited data request for zip code level data on homeowners insurance policies, and urge the office to go further in seeking more granular data. We should consider developing a public reinsurance program for states. Reinsurance price increases are a major driver of insurance pricing, and a public reinsurance program could allow states and communities to opt in exchange for agreeing to consumer protections and limiting or ending development in hazardous areas. We must support climate resilience communities. The IRA provided a large amount of federal funding to make our homes more energy efficient and climate resilient. FEMA also has hazard mitigation grants and buyout programs, and these resources are deeply needed, and we'll need more of them just to meet the current demand. We need to support states in lowering disaster losses by limiting or ending new development in hazard-prone areas, investing in climate-resilient infrastructure, and requiring insurers to provide premium reductions when property owners undertake home hardening improvements that will improve their vulnerability. And while my testimony has mostly focused on insurance, with regards to housing, we should require tenant protections on FHFA finance properties and crack down on private equity abuses. Thank you for the opportunity to provide testimony on these urgent issues. I look forward to answering your questions.
Thank you. And now we'll turn to member questions, and the chair now recognizes herself for 5 minutes of questioning. My background is insurance and financial services. I've been in that industry or was in that industry for over 20 years. So I find particularly interesting the comments and suggestions and your thoughts of being witnesses for this subcommittee hearing. You know, coming up to Washington, D.C. as a small business owner myself and never having a political position besides this one, I have found it very disturbing how when I sit in these meetings, the answer always seems to be more government regulation, more government involvement, or rolling out the government checkbook in order to help people all over this country. When as a small business owner myself, in the past, I saw the answer was often looking at my own business and seeing what I could do for efficiency, how I could help my customers and my consumers. And Ms. Nagy, you mentioned Florida. Now I'm from Texas. So Florida and Texas have a unique kinship. Mm-hmm. And how California has had stricter regulations when it's come to price increases for insurance versus California and Florida. And the first thing that comes to mind is the company that I worked with had to, just because something happens in California and they regulate more, does not mean that the prices go away or the increases go away. Instead, that price is actually distributed to all those other people to absorb the decisions that states like California make. So during a time of historic inflation, we just heard how we just heard how the president of the Association for the Builders Association said that nearly a quarter of average sales for new family homes have been due to some of this increasing regulation, this ESG policy. In addition, add on to that inflation, historic inflation under the Biden administration. Could you please share with me how we might be able to look at, instead of having more regulations, ways that we could cut regulations and reduce costs that would ultimately be handed down to the consumer to be able to purchase more homes, to get more insurance?
Well, thank you. Thank you, Congresswoman De La Cruz. I think, when thinking about the state-to-state differences, sometimes it is hard to make comparisons because, Florida has had a lot of hurricanes in recent years, and, Texas and California haven't. I think, though, if I was going to choose where I would rather be a consumer of insurance, I would pick California. In California, the insurance premiums are significantly lower. For a home worth $500,000, an average ratepayer in California is paying $1,822 compared to $4,929.
And I'm going to interrupt you right there. You're comparing apples and oranges. We just talked about insurance is based on risk. In the state of Florida, you have hurricanes, just like South Texas, where I'm from. There's also high wind risk as well that you do not have in California. So it's unfair to compare the cost because the cost of insurance is based on the amount of risk. So you don't have hurricanes. You don't have the same wind elements that you have in South Texas or in Florida. So I think it's unfair to compare those two when you're talking about apples and oranges. We saw in the state of Texas, NFIP was just recently here asking for more money because they're going broke. They took flood insurance away from insurance companies like my own and made it a government program. And guess what? We were asked to waive their debt because they are absorbing, and when I say they, I'm talking about the American taxpayer is absorbing the cost of these government subsidies. So I have real concern about further government regulation and the cost ultimately to consumers. With that, I yield back. I now recognize the gentleman from Missouri, Mr. Cleaver, who is also the ranking member of the subcommittee.
Thank you very much, Madam Chair. I love my grandmother, both my maternal and paternal grandmother. My maternal grandmother, I loved spending the night over there because I could make no mistakes and could do nothing wrong. The only problem I had is when she wanted me to go to the store, which is not a bad thing, except that I had to pass by Miss Naz's house. Miss Naz had a Rottweiler, and I explained to my grandmother over and over and over that I was scared of that Rottweiler, whose name was Satan.
Oh.
And so she said, don't worry about the Rottweiler, just don't look him in the face, just walk by. She didn't tell him that because he tried to climb the fence on me every time. And so I learned the lesson that ignoring something won't make it go away and will not make it friendlier. And if it can get out, it will be Satan on this whole planet if we continue to ignore climate change. Ms. Nagy, there's a growing concern about the lack of capacity in the insurance and reinsurance markets and the downstream impact it's having on consumers and property owners, mainly through massive cost spikes, coverage limitations, and exclusion of risk. Even worse, the problem is reaching crisis levels and has begun to raise serious alarm across the entire financial system, with trillions of dollars in uncovered and uncoverable risk. How do we stabilize the situation and prevent massive exposure to taxpayers in the wake of these disasters?
Well, thank you for that question, Congressman. I think at this point, this week as I testify before you, I live in upstate New York, and my neighbors in upstate New York and Vermont are facing the heartbreaking loss of life, devastation of homes, businesses, and beloved local institutions, all from an unusually severe rainstorm. I think we can say that this is no longer an issue that is a hypothetical. It's here right now. I mean, we all saw this very House building shrouded in wildfire smoke from the devastating Canadian wildfires that burned a greater area than any previous year on record, even before the wildfire season had began. And not to mention that we just went through the hottest June in recorded history. Financial regulators and institutions must manage and mitigate climate financial risks, not simply push the costs off onto consumers. Many lenders and insurers are contributing significantly to the climate crisis by internalizing short-term profits through their investments. Financial regulators really need to monitor these risks and risk management methods to protect consumers, financial institutions, and the financial system. In terms of how we can support localities, the first thing that we need to do is support hazard mitigation planning, programs, and buyouts where they're desired by the property owners. Land use is a very local issue, and there's rare times when federal programs or regimes really, impact things at that level. But, given the incentives for local governments to increase property tax revenue, there's always going to be a need to provide better incentives for states to reduce this development. I think also in terms of planning grants, hazard mitigation, and building stronger building codes. One person's unnecessary regulation is another person's lifesaver. And, I think as we all saw, with the recent implosion of the Titan submersible, regulations do have benefits. They do protect people. And I know where I would rather be in a safer, more resilient building in the case of any emergency.
Thank you very much. Mr. Boer, wouldn't it be better if we were spending a couple of hours dealing with this problem that is real than debating whether or not we ought to do anything and all of the issues that we don't want to pay any more money, we got too many regulations. Would it be better if we spent the time trying to figure out how we deal with this problem that is not going to go away?
Yeah, I absolutely agree. I think the industry's position is we want to make progress, and we have made good progress. I'll give you a little bit of background. When the DOE, early on in the process of promulgating these rules.
Gentleman's time's expired. I now recognize the gentleman from Missouri, Mr. Lukemeyer, who is also the chairman of the Subcommittee on National Security.
Thank you, Mr. Chairman. Mr. Theodoro, I want to focus for a second on some of the self-inflicted problems in certain state insurance markets like California, which you mentioned. That seemed to have a regulatory bias against insurers transferring risk from their balance sheets to the global reinsurance marketplace. From what I've seen, the ESG regulatory activism in California might be the worst of all. Right now, California is the only state in the country that does not allow insurers' rates to be based on their actual reinsurance costs. So as reinsurance costs go up, insurers cannot have their rates reflect those higher costs. As a result, more reinsurers are starting to treat wildfires as a primary risk and not a secondary peril. The cost of reinsurance has shot up while the cost of primary insurance companies of underwriting wildfire risk has stayed more or less flat. The natural result here is either insurers have to purchase less reinsurance or they will pull back from issuing new homeowners coverage in the state, as 3 of California's top insurers have done in this last year. So Californians get fewer options and higher prices, while the willing risk capacity of the $630 billion global reinsurance market goes underutilized. Mr. Theodoro, does it make any sense to you that California would deliberately discourage the use of reinsurance at a time when its primary insurers are actively fleeing its homeowners market? How would the great use of global reinsurance reinsurance and risk sharing help to benefit California consumers?
Yes, thank you, Congressman Lutkemeyer, for that question. Indeed, in California, where the cost of reinsurance is not permitted to be included in insurance rate making, you have a catch-22. The reinsurance rates are going up because the risk is going up, and the insurers have their hands tied, and they can't get more than a 6.9% increase. If it goes into the intervenor process, it may be extended beyond the 60 days. So it's unfortunate that California can't use reinsurance to its benefit. And then to the question earlier, too, about reinsurance capacity is there. The citizens in Florida got $1 billion of reinsurance from Warren Buffett's Berkshire Hathaway, and TWIA, the Texas Wind Insurance Authority, secured over $1 billion of reinsurance protection from the private reinsurance industry and also from the cat bond industry. So reinsurers do have the capital, and they're willing to deploy it if they can make a fair margin. So, and there are people that are standing on the sidelines, as Berkshire Hathaway was last year, when they didn't participate in the Citizens Program because the rates were inadequate.
It would seem to me that if you were incentivized to use the reinsurance market more, it would actually drive down your costs. I know when I was chairman of this committee 6.5 years ago, we were working on flood insurance, and we wanted to use the reinsurance market to help that situation. And if we would have done it over the previous 20 years, we actually would have paid all of our claims, never had anything, any tax bills go to the taxpayers, and still would have had coverage at a minimum rate increase. So there's a place for it. What is the percentage of increase in insurance costs due to ESG regulations? Mr. Theodore, you know offhand?
I don't have a number for this. The main ESG legislation is directed at state public pension funds.
Okay. Ms. Hewitt, one of the questions that I've got is with regards to the increasing cost of financing homes and how many people are unable to finance a home as costs go up. Rules and regulations, can you give me an idea of what the cost of rules and regulations are from the standpoint of your average cost of home? What would be the average cost of rules and regulations to a taxpayer or to the homeowner?
Yes, sir. Thank you very much for that question. The latest study that NAHB has conducted that was published in May of 2021 showed that regulations imposed by all levels of government accounted for $93,870 of the average price of a single-family new home, which that average price was around $397,000. And that's about 23.8, almost 24% of the price of a new home. Our studies also show that for every $1,000 increase, 149,000 people are priced out of the market.
Okay, so for every $1,000 increase in the cost of financing a home, 149,000 people are unable to get themselves into a home. Is that what you just said?
Yes, sir.
Thank you very much.
The gentleman's time has expired. The gentlewoman from New York, Ms. Velasquez, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Nagy, worsening climate-driven natural disasters all over this country, not just along the coasts, are impacting the affordability and availability of property insurance that helps mitigate risk. A recent report by the National Multifamily Housing Council indicated that the average increase nationwide for property insurance coverage at apartment communities was a staggering 26% through early 2023. And in some markets, or at some properties, like many affordable housing communities, we have seen triple digits increases. Soaring operational costs like this are straining property operations and adding to the cost of housing. How can this committee work towards providing some relief and drive greater capacity in the insurance and reinsurance markets to help address these soaring costs faced across the country?
Yes, the issue of insurance for multifamily housing, and particularly for new affordable multifamily housing development, is a major issue. And this is another area where I think consumer protections do have a role to play. In New York City, we're seeing insurers ask questions about, how many folks living in this apartment are going to be receiving Section 8 benefits. Now, in any other area, of New York housing law, that would be source of income discrimination.
Right.
But with the insurers, we do not know what formulas they're using. They really treat their rate setting as a proprietary black box. And as a result, we have seen a lot of discrimination in how prices are set using algorithmic models, such as to model things like crime rates. So this is obviously an issue that is very concerning. State regulators really have a role to play there, but so does the federal government. And that's why the Federal Insurance Office's data request is so important, and that's why we support it, because we really can't even know what the problem is until we get a sense of what's happening at the different state levels. So we can better, compare, as the Vice Chair said.
So there is a role for the federal government.
Absolutely, yes.
Okay, thank you. Ms. Yui, is there anything you would like to add?
No, ma'am, thank you.
Okay. Ms. Yui, it is no secret that LMI and communities of color are often the most impacted by devastating flooding and other climate-related events. Within these communities, affordable housing or smaller rental properties can be disproportionately impacted, as the current structure of federal flood resiliency and disaster mitigation efforts is directed elsewhere. How can we leverage federal resources and tools to drive better disaster protection and mitigation efforts toward the most vulnerable?
I'm sorry, could you repeat the question?
How can the federal government redirect resources to mitigate the impact of climate change in communities, in LMI communities and community of color? How can we leverage federal resources and tools to drive better disaster protection?
Yes, ma'am, thank you for that question. I believe that with all housing and certainly government assistance programs and things like that, if we look at the existing housing stock that we have, new construction is already so energy efficient, and we build such a tight house in new construction because of the regulations that we have now, and we are happy to do that. But if we look at the existing housing stock, and I can't remember the exact number of housing that there is, that is where we can address a lot of climate change, I believe. Homes and projects that were built in the 70s, to give them incentives for better insulation, higher SEER unit and HVAC unit, caulking around the windows and things like that would go a long way in helping climate change.
My time is up. Thank you, Mr. Chairman.
I thank the gentlewoman. The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Nagy, let me ask you a question. I asked some environmental activists that came by my office. Do trees have lives? Put your microphone on.
I'm sorry.
Do trees have lives like people? Do they grow and then there's a point that they die? Do you realize when the activists, I asked the same question, and they said, "What are you getting at?" I said, "It's a very simple question. Trees have lives." And They basically said, no, it's left untouched. The reason in California, if you ask any forester, the reason your forest fires, you got these regulations that are letting thatch build up 2 and 3 feet. That doesn't make sense. And then for the commissioner in California to let government bureaucrats dictate rates that private insurers can charge is ludicrous. In your role, you got a great example to actually go talk to a forester, and it can be maintained. But if you're never going to cut a tree, if a tree lives forever, if you're never going to cut them and log them at a proper time to allow nature to take place, the forest to breathe, if you're never going to take thatch away that's kind of a tinderbox, then you've got a problem. And that's a lot of the reason that California's having the problems that they're having. Mr. Boer, in your industry, you serve over 22 million Americans that buy manufactured housing. You and I were talking the other day, which I appreciate you coming by, some of the issues you're facing that's ruling the most affordable housing market that there is. If you go into a manufactured housing plant, they are doing an amazing job that site builders cannot do. It's controlled by a building that rain and the weather doesn't affect it. Tell me some of the things you were telling me about these regulations that are going to rule the most affordable housing and the most promising housing in the country. Go over a few things.
Yeah, I appreciate the opportunity. I think along your point, manufactured housing really is serving the lower price points. So when we talk about affordability, people tend to talk about it at the median. And I think we're at the place where the rubber hits the road of whether people can buy a house or not. But yeah, to give you some specific examples about the changes that would be required by these regulations, we would have to build thicker walls from 2 by 4.
Give me an example, from 2 by 4s to
2 by
what?
4 to 2.6 by 6. We'd have to dramatically increase the insulation. That would cause us to increase eave heights. And by doing that, we have to get higher pitched roofs that frankly would not work for the transportation of many of our homes to sites. It would require heating and cooling equipment that frankly is not available to our industry right now in sizes that it would require. So there's a lot of aspects like that. Windows that would require argon gas, which our industry currently doesn't have a supply for. So we would be redesigning thousands and hundreds of thousands of floor plans and trying to get those approved through the DAPIA process and the HUD certification. It would be a very difficult transition for sure, but it would dramatically change the design and increase the cost for prospective homebuyers.
And wouldn't it behoove someone that's putting regulations on you, whether it doesn't matter what agency, to come to your plant? When I have a problem, I go to carpenters. I don't go to bureaucrats who've never nailed. They wouldn't know a nail from a toilet. So wouldn't it behoove those making regulations come by your plant or come by a plant and look at it?
Yeah, and we have another process under HUD where if you work through the HUD process, we've got a consensus committee there that's made up of consumer advocates, people from the industry that can help to understand how to come up with regulations that actually work for our industry. And that's what we encouraged at the front end of DOE's process. I started to speak earlier that at the front end, myself and other CEOs in the industry met with White House staff, and our message was, hey, we're on board. Let's go raise the standards for energy efficiency, but let us be part of that so that we can make sure the mandates and rules that are put forth actually work for our industry.
And agencies work for us. We don't work for agencies. We pay their salary. A lot of times that's forgotten in the real world of America and the real world of business. Well, I would just urge you to keep at it. Invite every one of the panelists to a plant and let's let them take a look at it. Thank you so much.
Thank you.
The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Chairman. This is, I think, our third hearing on this. It's bizarre to me because, one of the things that I've been really appreciative of previous administrations and others been talking about, movement around, weatherization and, even manufactured homes doing the kind of upfront, and it does cost money up front, but it leads to reducing, reliance, high utility bills. Energy efficiency leads to actually lower bills for many of the families, and they can't afford it. So it's not all going, right out the window when we don't have some of those investments at the front end. So it's really bizarre for me, and we continue to hear this as, oh, the whole housing crisis is because of this. I'm taken aback because we all know it existed before even the ESG even was invented or created. And so, I know in my district, for instance, the tax foreclosure crisis was just unbelievable. We had one of the worst tax foreclosure crises in the country. These are families that actually own their homes, but they could not pay for their property taxes. ESG had nothing to do with it. Nothing. Actually, probably if it did, maybe there would have been some sort of best practices or policies implemented. But they're also acting like ESG is like binding. Is ESG binding? Ms. Nagy?
It really depends on whether by law it is.
Yeah, they
Otherwise,
decide.
It's a standard, yeah.
Is it binding?
It depends on the legislation and possible litigation.
I know, but right now, ESG policies, is it binding? Is it forcing people to, is it binding?
It's not.
It's advisory, right? It's like you should look into this.
It's a factor that can be looked at because it may have correlation with risk magnitude, and it's consistent with fiduciary duty in the investment community.
Sure. How about you, ma'am?
Codes requirements are binding, yes, ma'am.
Oh, they're binding. They're requiring them to look at these things because because it's actually increasing their mortgage payments? Is it increasing the cost of home? I mean, I don't understand.
The 2021 Energy Code would increase the cost of a home, about, I think some of our members say about $31,000 in their area.
So one of the things that my colleagues talk about is manufactured homes, and it's about 11%, I think. Is it 11%, Mr. Bird? Like 11% of single-family homes are manufactured housing, is that correct?
Yeah, from that to the mid-teens.
Yeah. So one of the things that they were trying to advance is energy efficient standards for manufactured homes, which many have claimed have made them unaffordable. But though the data and everyone shows that the cost to comply with energy standards, actually those improvements reduce maintenance utility costs for manufacturing housing residents in the long term. Is that correct?
That's not correct.
Really? Why is that?
Well,
you tell me, because you're all acting like this environmental, this whole little policies around looking at the fact that we have a climate crisis is increasing the cost of manufactured homes, which we all know is because of private equity firms, because of investors. Ms. Nagy, you know I'm right. All this existed before that. And now that we're telling them, hey, you gotta be more responsible, that all of a sudden we're saying, no. You're the reason that we gotta increase costs on these folks.
Private equity firms aren't generally involved in the manufacturing.
I'm just telling you, this is overgeneral because it's only 11% of your business. You're saying right now that's not the reason that manufactured homes are rising costs. You're saying it's ESG.
I'm saying it's a contributor, and it is binding.
It's a contributor?
It is.
When did ESG come up in the manufactured homes industry? When?
ESG is a framework. It's the mandates.
When did it come about? When did they start talking about? 2019? 18?
We're facing these DOE.
When did they start talking about ESG in your industry? No, I really mean it, you guys, because understand this. This is the bizarre thing. I've never even heard of ESG until now. Like I'm really curious because to me, my families, they've seen the rising cost of housing, not because of ESG. It's because of all the other issues I wish we would be more targeted around talking about. Because majority of the homes in my district are less than $100,000, but we can't get some of these banks to actually loan because it's not profitable. So somebody that wants to buy a $60,000, $70,000 home in Wayne County, Michigan, can't find somebody to lend it to them because it's not profitable. So what do they, literally everybody else is swallowing up these homes because 60, 70 investor firms come together, they buy a bunch of them, they turn them into rental properties. Where literally I have a block and like 2 people own their homes, the rest of them are literally renters. And they're paying way more, much more than what they would have paid if they had gotten a mortgage from some sort of banking industry. I say this, and I really don't want you all to see, I'm not disrespecting you all, but please don't make this about ESG. You're actually failing your members in your industry and literally your sector by focusing on ESG and not the root causes of why the cost of housing is going up in our country.
The gentlewoman's time's expired. I will notify the committee that votes have been called. There are 12 minutes remaining and about 412 people who haven't voted yet. Given the number of people that are here, my plan is to come back. If you would like to ask questions, we will continue the hearing immediately following votes. I would ask to get your final vote in early so we can come back and get some semblance of a quorum here and move forward with questions. Before we adjourn, I think we have time. I think we have time for at least one more. And so I will now recognize the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thank you, Mr. Chair. For about 150 years, state insurance regulators and laws have regulated insurance companies. The Federal Insurance Office has grown increasingly aggressive in collecting data from insurance companies, most recently issuing a proposed data collection to assess climate-related financial risk. FIO intentionally chose to not collaborate with state regulators on this climate data call. Treasury's own proposal concedes it could take 350 hours for the industry to produce the data. That is why I plan, and I think some other members of the committee will be part of this, to repeal the FIO subpoena power in the coming weeks. Mr. Theodoro, can you just quickly discuss the Federal Insurance Office, their accumulation of power in recent years?
Yes, thank you, Congressman Fitzgerald, for the question. Indeed, the Federal Insurance Office was created as part of Dodd-Frank because it was thought that insurance companies were in part responsible for the global financial crisis, which was not the case. It was banking and non-bank lending institutions. And the role in statute of the FIO is to monitor the insurance industry. There's no regulatory powers there, but as you have suggested, Congressman, there has been more intrusion and requests, data calls, and I think duplicative data calls, because most of the large insurers, especially the publicly traded ones, already make detailed, granular climate disclosures, either in their 10K or in other publications or disclosures. So to me, it's disturbing that it's like the nose of the camel is in the tent and then the rest of the body is going to follow. It strikes me as an agency that's looking for a purpose.
Right.
Because monitoring, writing reports hasn't helped the industry that I have seen in a material way.
Yeah, Ms. Huey, can you talk about the importance of giving communities flexibilities of more self-sufficient and their ability to protect themselves in the face of things like the floods and wildfires and tornadoes? I mean, this is what the industry is looking at is, what are the risks associated with what we've seen, not necessarily in climate change, but just some of the extreme weather that we've seen?
Yes, sir. Thank you very much for the question. Local decision-making is critical as local experts are more in tune to the local conditions and the needs of those communities and municipalities. But with that authority must come the flexibility to do what makes sense for the community. For example, in the codes arena, local governments must retain the ability to amend model codes to accommodate local conditions and cost-effectiveness concerns, which include consideration of risk and reasonable steps that can be taken to reduce those risks. Communities must also be open to reconsidering local zoning and helping developers overcome the NIMBYs and other challenges so that development can occur in places that are best suited for community growth and where much of the market needs it to be.
Very good, thank you. Mr. Chair, I'll just ask unanimous consent to enter Department of Energy press release into the record. And I also, I request that this be, I think the featured press release from DOE is very telling. Mr. Bohr, does this rule, does the rule from DOE that we were talking about earlier in any way affect mobile homes? Will this help anyone currently residing in a mobile home? I can't see where this would help them.
No, the rules would affect new homes, so no one currently in a home would be helped.
Will this help anyone currently residing in a manufactured home?
No, only new homes would be subject.
Yeah, so probably what you're telling me is that DOE probably doesn't even understand or fully understand that the rule that they've actually issued.
Yeah, I think their assumptions about the benefits are dramatically overstated.
There's probably an underlining misunderstanding about your industry, right? Can you just,
we certainly feel so. The rules were promulgated that have some, well, they're based on site-built standards. And our process is it just doesn't work that way. We can get a lot of the benefits. We've done a separate study through the HUD committee, and we can get a lot of the way to where they're trying to get from energy efficiency, but with process-appropriate approaches.
Yeah, so this is real-world, tangible stuff. Whether it's 11%, like my colleague just referred to, or some other percentage of Americans that are living in manufactured homes, this is real to them. There's real costs associated with it.
Yeah.
And there's departments like DOE that, quite honestly, are out of touch with what's going on in the street. And that's really what this committee should be about. So thank you, and I yield back.
I thank the gentleman. I now recognize the gentlewoman from California, the ranking member of the full committee, Ms. Waters, for 5 minutes.
Thank you very much, Mr. Chairman, for this meeting, this important meeting that you're holding on housing, and particularly, as I understand it, as it relates to ESG. I would like to bring to your attention a particular issue that I think so many Americans are facing right now. For Ms. Nagy, the number of people paying unaffordable rents recently reached an all-time high, with the average U.S. renter now paying 30% or more of their income on rent. Monthly mortgage payments have also reached all-time highs, surpassing $2,900 per month. In fact, in my state of California, someone making the minimum wage would need to work nearly 3 full-time jobs to afford a 2-bedroom rental home. And California is not alone. There is currently not a single state or county in the United States where a minimum wage worker can afford fair market rents. Meantime, corporate landlords who continue to grow their market share of housing have used inflation as an excuse to hike rents and accumulate excessive profits on the backs of tenants. This is why last month I introduced the Housing Crisis Response Act of 2023, which would make historic investments to increase our nation's affordable housing supply, reduce rents, and help end homelessness. Do you believe federal investments are needed to fully address the nation's worsening housing and homelessness crisis?
Yes, absolutely, Congresswoman. We have a severe national shortage of homes that people with the lowest incomes can afford. Nationally, we need 7 million homes that are affordable to Americans who live below the poverty line or who earn below 30% of the area median income. Unfortunately, because of actors like Blackstone, we are losing what remains of our affordable housing stock at a rate faster than we can replace it due to rising rents and stagnant incomes. Many homes that were once affordable to lower income people have seen their rental or purchase prices increase. In just 3 years, 36 states lost more than 10% of their lower rent units, and 14 states lost 15%. So we do need to build a lot more affordable housing, and we need zoning reform to do it, because in much of the country, only single-family zoning is allowed. Absolutely. We also need to look at the federal government's role here. The FHFA spends billions of dollars purchasing and guaranteeing multifamily property. And as we've seen, this has really resulted in very poor conditions for some tenants, because there are some deals that only pencil out if you evict the lower paying tenants or if you skimp on maintenance and repairs. The FHFA has a number of requirements for receiving its loan guarantees, and I think it is past time to consider the well-being of the folks who live in these buildings, because this is, while housing is regulated at the local level, this is a national problem, and the federal government does have a role to play here.
Well, thank you so much. So given all of this information, all of this knowledge, the crisis that we have in this country, do you support the federal investments for affordable housing in my bill, the Housing Crisis Response Act, including specific investments for green and resilient housing?
Yes, absolutely. I think we are already seeing, the resources in that bill really, should have been passed earlier because we have a huge need in deferred maintenance and public housing. As you know, I think in terms of, sorry, I just.
That's fine. I want to ask Ms. Hewitt the same question.
Okay.
Do you support the Federal Investments for Affordable Housing in my bill, the Housing Crisis Response Act?
Ma'am, I know that we have supported your legislation in the past, and I believe that our association is looking at that legislation. So we are looking into it, yes, ma'am.
Thank you. Keep looking. I yield back the balance of my time.
I thank the gentlelady. Recognizing that we have 2 full minutes remaining for votes, we'll adjourn. It should be roughly 11 o'clock when we come back. I would estimate it might take 11:10 or so if we wrap up there. So I guess be prepared in that time range. So I would correct that. We won't adjourn, we will recess. We'll adjourn at the end of the hearing. So the committee stands in recess. The committee will come to order. The gentleman from Nebraska, Mr. Flood, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Boer, one of the most detrimental regulations impacting the manufactured housing industry has been the Department of Energy's proposed energy conservation standards for manufactured homes. This regulation would impose stringent new requirements on the construction of manufactured homes, raising costs on one of the few affordable options for consumers, especially in rural areas like Nebraska, where I represent. Fortunately, the DOE has decided to delay the compliance date for this rule after significant stakeholder feedback. Can you speak to the impact this proposed rule would have on the production of manufactured homes?
Yes, thank you for the opportunity. The rules we've got processes under the HUD code where every plan for a house is engineered and approved. The rules would cause us to basically have to redesign every floor plan because of costs that are added in the weight of the house, the thickness of walls, the elevation of the roofs, number of windows that could be included. So it's really a complete redesign of all of our designs that would then have to go through a recertification process. The costs are, a lot of the costs involved are the actual changes to the design once you get through that process. But the other thing that's still undetermined is how the DOE rules would actually be tested and how they'd be, how the compliance process would go. We estimate that that could cost another $1,500. And what I'd like to point out is, we're talking about, it's hard to give you one number as far as the total cost because we've got different house designs and everyone's going to be a little bit unique, but I think a rough number might be for the actual changes to the design might be in a range of $6,000. There's a big range around that. Add another 15 potentially for the cost of compliance, which hasn't really been defined by DOE at this point. And so let's just say $700 to $7,500. That may not sound like a lot, but I'll make 2 points. One is the typical cost-benefit analysis looks at will that money get paid back for the home buyer over 10 years. Using DOE's analysis, which we do think is somewhat flawed, but we didn't change it. We just updated it for current costs. For the vast majority of our homes, it would not get paid back. And the bigger point is $7,000 for a customer that might be a $50,000.
I appreciate your answer. I'm going to reclaim my time. You and I are on the same page. People need to understand that. I want to just switch gears here and go to the auto insurance market. The average California annual rate for auto insurance in 2023 was $2,462. Meanwhile, the average rate in my home state of Nebraska, $1,538. That's a striking difference of almost $1,000 annually. California fashions itself as the home of innovation, but its broken insurance and regulatory framework doesn't even allow drivers voluntarily to share telematics data with the insurers in exchange for lower rates to reward good driving. For those who may not be familiar with the term, telematics can be installed in a car to track speed, harsh braking, or other indicators that may affect an insurance rate. Basically, by allowing drivers to opt into this, you're giving them an opportunity to lower their rates by demonstrating they're a good, safe driver. Mr. Theodoro, can you discuss how the use of innovative technology like telematics in auto insurance could lower rates, something Californians miss out on and Nebraskans take advantage of?
Yes, thank you, Congressman, for the question. Indeed, telematics can lower costs. If we look at the history of automobile insurance rating, we start with bureau rating, where the rates were set, and then segmentation, looking at city drivers versus farmers, for example, looking at risk factors, and then more granular segmentation, and then the development of big data, so pulling in different data elements, because insurance companies are, by and large, in the data management business. They look at the data. So telematics data even makes it more specific, which it looks at things like hard braking or turns that are very abrupt, and it feeds this information back to the driver and to the insurance company so that the risk based on the quality of the driving helps to determine the price. So the capital is allocated according to the level of the risk. So it's counterproductive to ignore this kind of data. It's being used in the trucking industry. Commercial auto insurance is benefiting from trucks that have front-facing cameras that look at driver behavior, are they falling asleep, and feeds this data back, and it
Thank you,
leads to
Mr.
lower
Thurdo.
costs.
I must yield my time.
The gentleman's time's expired. The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thank you to all the witnesses today. I just want to be mindful of the topic of this subcommittee, how mandates like ESG distort markets and drive up costs for insurance and housing. And Mr. Chair, I've got to admit, I sat and listened to all the opening statements, and I'm not sure that any one of our witnesses really gave us any example or any real data in connection between the disclosure requirements, which is simply about data and being transparent to disclose what you're doing, to how it actually distorts markets and drives insurance costs. I mean, I've been listening. But again, it's just a reminder to the people back home that, again, this is just about transparency. It's about making sure we have the data to make the right decisions in terms of investors and consumers. So instead of addressing real problems that my district faces, like high housing and insurance costs and accessibility, we're here today because Republicans are trying to forbid simple common sense data from being the public. For some reason, they've gotten on these anti-ESG and anti-woke crusade, whatever that means. It's really perplexing because, again, in my district, we're worried about natural disasters. We're worried about the next hurricane season. We're worried about flooding because in Houston and in Texas, that has happened more often than we can talk about. And ma'am, I know Ms. Nagy, I think you said that it was California and Florida that have a lot of the flood. You know, Texas does too. In Houston and in our region is very flood prone. For us, it's not about if we'll have a disaster, it's when it will come. So that's why insurance and housing costs are of utmost importance to me and my constituents. And it's very, very relevant and right now, especially as we're facing hurricane season. I know that my home state has already tried to dabble in all this issue. They passed a bill, SB 833, that banned ESG risk analysis in the insurance sector. And surprise, surprise, it drew a lot of opposition from a host of insurance trade groups. So again, ESG is data and disclosure. And I think all our witnesses have frankly have failed to connect the dots as to how that it affects the markets, increases insurance rates, and impacts housing. Any Republican-led constraints on risk analysis or limitation on data should be seen as antithetical to the entire business model of insurance industry. There is now widespread concern that Texas bill will deter more insurance companies from entering Texas market at a moment when growing flood risk has already made the Texas insurance market highly vulnerable. I've already heard about insurance companies leaving other high-risk states like California and Florida, as was mentioned earlier, denying consumers choices and coverage they desperately need and deserve. And this is what it's all about, is being able to give the consumer and the investor the choices to make the right decisions based on the data that is disclosed. So, Ms. Nagy, I have a question for you. Given that insurance is a major channel through which climate risk is transmitted to the financial system, can you speak to the dangers of restricting insurance companies from using data and risk analysis in doing their business?
Yes. So, in terms of, I think I understand. You're talking about are you referring to the Texas anti-ESG law that prohibits insurers?
Right, but we don't have to speak specifically about the Texas law. Where it just, I think that's what some of my colleagues would like to do nationally. But can you speak to the dangers in restricting insurance companies? Because again, I think, was it you who mentioned that, we really have no role in this other than the National Flood Insurance. Most of the all the insurances are go through their state systems for their doing business. So I'm really not even sure why we're doing this hearing. We should be focused on extending the National Flood Insurance Program and improving it and make it affordable and make it accessible, especially to flood-prone areas like us. but apparently we're dealing with it. So could you tell me what the dangers are?
Well, I mean, absolutely. Climate change is real, and insurers need to be able to take that into account when setting rates. The public, too, deserves transparency in terms of how are rates being set and where are folks having higher or lower rates. I think both cases,
Mr. Chairman, I did have a couple of other questions. I'll submit them to you for the record to get the responses in writing.
I appreciate the gentlewoman. The gentleman from New York, Mr. Lawler, is now recognized for 5 minutes.
Thank you, Mr. Chairman. It is amusing to listen to some of my colleagues feign ignorance about ESG and the impact it has on the market. They know exactly the impact it has on the market because they've been advocating for government intervention in our market economy for years. If you look in my state of New York, as I mentioned in yesterday's hearing, with the New York State Pension Fund and the New York City pension funds and what they do to try and dictate to companies as shareholders, it's remarkable. You look at our housing market and you see what New York is doing just this year, banning gas stoves, banning natural gas hookups. This is a state, and California being another one, where they are absolutely seeking to use their influence to upend the marketplace. They don't believe in free markets. They don't believe in consumer choice. In fact, they're trying to limit consumer choice. And what it does is it drives up the cost of housing. So at the very time they talk about the need for affordable housing, when you limit choice within energy, you drive up the cost. The average homeowner would have to pay about $30,000 to $35,000 to convert their home from gas to electric. That restricts. That causes a more difficult challenge. I'm not asking a question. That causes a more difficult challenge for someone to purchase a home. So if we want to actually address the challenge of affordability, if we want to reduce cost, then we need to actually allow the marketplace to work. In New York, 60% of New Yorkers rely on natural gas. 70% of electricity is generated by natural gas. So if we're going to increase the need for electricity by converting everyone from gas to electric, how are we actually going to create that needed electricity? So there are a lot of policies that get enacted precisely because of ESG that are having a profound negative impact on the marketplace and on the economy. And as I mentioned in yesterday's hearing, New York State's pension fund just returned a negative 4% return on investment. And what does that do? That hurts the taxpayers because the pension fund has a guaranteed 7% return. So who picks up the tab? The taxpayers. At the same time, New York is facing a $13 billion budget deficit, and California is looking at a $35 billion budget deficit. Great policies, really working out really well. It's a disaster. But because we want to say this is what should be, instead of letting people choose what they would like, most Americans would like companies and corporations to focus on their product. You build a home, build a home. Why are you getting involved in politics? You sell goods, sell goods. Stop getting involved in politics. People are tired of it. And shareholders certainly want to know that there is a return on their investment. Otherwise, why invest in the company if you're going to have a loss? What's the point? So where do you get the capital from if that happens? We are making really bad policy decisions in the name of politics. And it is creating havoc all over the place because politics now consumes everything. Leave the politics for the committee rooms, for the chamber, and let businesses do what they are set up and intended to do. We see it every day how this is impacting. So yes, ESG does have a profound impact on our economy. Yes, it does have a profound impact on our housing and insurance markets. And yes, we should be environmentally conscious. And yes, we should be making decisions to reduce carbon emissions. But we also need to make decisions that allow for the economy to grow and that create a situation where we have clean, cheap, reliable energy policies and that positively impact the marketplace. And with that, I yield back.
The gentleman's time's expired. The gentlewoman from Georgia, Ms. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to all of our witnesses for joining us today. Mr. Chairman, I'd like to ask for unanimous consent to enter this picture into the record.
Without objection.
Thank you. I appreciate the opportunity to speak on this topic because, y'all, I am living through my own experience directly related to the impact of climate change on housing and insurance. So I bring my full lived experience to this hearing today. If you look at the image behind me, this is my 7-year-old son, my Carter Cakes, holding a golf ball-sized piece of hail from a hailstorm that was in my neighborhood on March 26th of this year. I live in Atlanta, Georgia. Now, y'all might be thinking, what's so extraordinary about a picture of hail? Well, it was quite exciting for Carter, but that Sunday evening, my entire neighborhood experienced a catastrophic hailstorm which dropped these golf ball-sized hailstones on our homes, causing so much damage to our roof that we had to file an insurance claim. I would like to say that the story ends there, but sadly, it doesn't. Because of this extreme weather event, which was out of my control and happening more and more frequently, especially in the warm state of Georgia, I was notified that my insurance agency, State Farm, was deciding not to renew my homeowner's insurance. So as of July 29th, I have no idea what I'm gonna do. My husband, who's with me here today, I don't know what we're gonna do for homeowner's insurance because State Farm won't renew our policy because we filed a claim. I was devastated because this is a necessity for homeowners and it's a requirement for most mortgages, including mine. As insurance companies increase premiums and refuse to renew policies due to increasingly common extreme weather, first-time home buyers from marginalized communities will be the most impacted. This can ultimately stall any progress that has been made in closing the racial wealth gap through home ownership, one of the primary drivers of wealth generation for Black and brown communities. And this means that places like Atlanta, my home, and unfortunately the national leader in the racial wealth gap, my constituents' hard-earned equity is being destroyed by climate change because it's real, y'all. But unfortunately, I'm not the only American who has been or will be dropped by their insurance agency due to extreme weather events beyond our control. Just look at the insurance companies pulling out of states like California due to wildfires or Louisiana due to floods. Insurance companies are actively evaluating the risk of insuring homes in the areas most impacted by extreme weather and realizing how detrimental climate change is for their business. Because climate change is real and it does have an economic impact on the long-term profitability of companies. Clearly, climate change needs to be considered in the decisions of insurance companies, but we also need to make sure that our most marginalized communities who are most impacted by climate change are not prevented from building wealth through home ownership. Ms. Nagy, maybe, am I getting your name right? Nagy. What actions can the federal government take to lower insurance costs for Americans and make sure that homeowners remain insured?
Thank you for that question, Congresswoman Williams. I'm so sorry that happened to you. That's really not fair because you were doing everything you were supposed to. You were paying money for your insurance, and it sounds like they were happy to take your money
every month
when things were going well. And then all of a sudden, when you need them, once you actually have a problem, then they withdraw coverage. I mean, that doesn't sound like a good neighbor. That sounds like a fair weather friend. You're not alone, unfortunately. 400,000 Floridians lost access to property insurance in 2022 alone. So if this is what a lack of regulation is doing to consumers who are doing nothing wrong. And this is a real problem, and one where the federal government should step in. Now, obviously, the federal government doesn't regulate insurance at the Fed, because it's a state issue. But I do think there are things that states can do, or that the federal government can do. I'm very interested in examining public reinsurance options because, as we know, the reinsurance market is global. They're not even in this country, so we can't really, we don't have very much to say about what they're doing with their rates, how they're setting them. So I think that is, one major area to explore. And I think you could have buy-ins like consumer protections. You can't just drop people when they have problems. Like you have to continue to provide services, or have, the state-run fair plans. They should be more affordable to you.
Mr. Chairman, I am out of time, but I have many more questions because of this impact that is personal to me and my neighbors, and I would love to present them for the so that I could get a written response for the record.
For the record.
Thank you.
I thank the gentlewoman. The gentleman from New York, Mr. Garbarino, is now recognized for 5 minutes.
Thank you. Thank you, Mr. Chairman, and thank you to the witnesses for being here. Ms. Hugh, I want to start with you. When we talk about this issue, no matter what trendy new terms or acronyms we're using, I think we're all mostly in agreement that we should be doing more on the make smart, upfront investments in homes and infrastructure that will ultimately save lives and taxpayer dollars, and do it in a way that's not burdensome for homeowners or consumers. For instance, we have all heard that the stat that says $1 spent on resilient construction will save $11 in future costs. But I think we often talk about this in a context of new construction, which, while very important, results in us losing focus on existing homes and ensuring we're giving folks the tools they need to upgrade older homes that were built long ago. Can you talk about the costs to homeowners and, frankly, all Americans if we continue to ignore older homes and just focus on new homes?
Thank you very much for the question. I really do think, as I stated earlier, that if we can offer some sort of incentives and things like that to existing homeowners to upgrade their HVAC unit to increase the energy efficiency of their home. Right now, the 2021 Energy Code has us going from 5 air changes to 3 air changes in a home. If you've got a window cracked, that could be 30 air changes. A house built in 1970 probably has 30 or 40 air changes in an hour. So if we could increase the efficiency of those homes, it would go a long way in helping with climate change. Existing homes are already so energy efficient. You're really just tweaking something that's not going to make a big difference in the energy efficiency of a home, but it's going to cost a lot to new construction.
Thank you. And I just had to have my air condition fixed. It's about, I think it's 30 some odd years old. It's a tank, but it's definitely, I'm sure, not very efficient. I'd like to move on to something, we just talked about new construction a little bit and making home costs more affordable and, just better for Americans. In New York, there's talk of, and I know my colleague brought up, the ban on gas stoves. Currently, between 60 and 70% of New York families have a natural gas stove. State of New York, the governor and the legislature recently pushed through a gas stove ban for new buildings in its most recent budget. This first-in-the-nation ban will increase energy costs for New Yorkers, stress the electric grid, and eliminate consumer choice, all while having a minimal environmental impact. Furthermore, adding further government red tape and regulation to new construction will further drive up housing costs that prices working families out. Unfortunately, we're seeing this same ill-advised policies pushed on the federal level as well, with recent efforts from the Department of Energy and Consumer Product Safety Commission. How do these efforts, Ms. Huey, affect the housing industry, and if implemented, would these efforts drive up costs on Americans?
Thank you again, sir, for the question. Many home buyers want gas stoves in their homes, and I know that I do. As a home builder, I believe it is my job to provide my customers with appliances of their choice. Gas stoves are used by 40 million homes nationwide and have proven to be safe and efficient appliance of choice for families for well over a century. The recent push from federal agencies to regulate gas stoves will drastically limit their availability across the country. Recently, I built a home last year or I guess in the last 6 months, for someone, custom home, and she loves to cook, put a gas, wanted the gas stove, and we're walking through, going through the walkthrough, and she looked at me and she said, is the government really going to take my gas stove from me? And I said, no, ma'am, they're not. Thank you.
In New York City's trying to get rid of coal-fired pizza, or brick oven pizzas. It's terrible. Last question, Monsieur, for you. Often overly rigid local environmental and land use standards prevent homeowners from being able to make responsible decisions to reduce their risks in their homes from devastating natural disasters. One example is California, where stringent building requirements have hampered infill growth in areas at low risk of wildfires and instead driven homeowners into the highly vulnerable wildland-urban interface, putting them at increasing risk of extreme wildfires. Can you talk about the importance of giving communities the flexibility to foster development that lets them be more self-sufficient and protect themselves in the face of things like deadly floods, wildfires, and tornadoes?
Yes, thank you again, sir, for the question. Yes, I believe, and I discussed that a little bit earlier, and I believe it's in my written testimony, giving local jurisdictions the choice of certain codes that they impose, I think, is imperative, because the climate in every municipality is different. Even in my state, from cold weather I'm from Alabama, from Huntsville down to Mobile, where it's warmer. So I think it's imperative that we give the choice to those local municipalities. Thank you.
The gentleman's time's expired. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Mr. Chair. You know, I've been in Congress now almost 4 years, but prior to that, I was on the municipal level for 8 years, and I was an aide for 16 years. So I've been in government long enough to know that it moves slowly, at a deliberate speed. And I'm a patient woman. But on the issue of climate change, we have run out of time. And now is not the time for anti-science, anti-environment culture wars. Now is the time for action to confront the climate crisis, because our community simply cannot afford to wait any longer. More and more individual lives are being impacted. More and more homes and communities are destroyed by natural disasters each year, whether it's tornado, wildfire, or hurricane, which is one of the many reasons why I'm grateful that President Biden signed into law my legislation, the Post-Disaster Mental Health Act. But, you know, to those who would seek to weaponize what it means to be woke, I'm unapologetically woke. I'm awake, and my eyes are wide open. Because I owe it to my constituents to not look away. In my district, the Massachusetts 7th, failure to address climate change means greater flood damage to frontline communities like Chelsea, Everett, and East Boston. So to my colleagues across the aisle who seek to obstruct and oppose legislation and policies that will help our shared constituents around the country protect their homes from climate change, it is not only alarming that you would move in this way, it is downright dangerous. Ms. Nagy, since U.S. property catastrophic reinsurance rates increased by as much as 50% on July 1st renewals, my constituents have had to pay more to protect their homes and their livelihoods. Can you highlight the impact of these price increases on the insurance rates paid by consumers?
Yes, thank you, Congresswoman. Yeah, so as I said, you know, earlier, the reinsurance industry is not located in the U.S., so we really don't have much of a say over what the rates are. You know, they tell us, they tell insurers, and insurers pay them, and that's how insurers are able to then offer, you know, their product to individuals. So the idea of having a public reinsurance option for states to opt into could be a really powerful incentive to truly limit development in some of the most disaster-prone areas, because you know, while we can all agree that folks shouldn't be there, it's real. You know, at the local level, with, you know, they're often more concerned about property tax revenue above everything else. You know, and so you get this very short-sighted decision making. I think that the federal government can do a lot more to support, you know, to support making our homes more energy efficient, new construction, having, you know, things like induction stoves. And, I actually I'm a homeowner who switched out a gas stove for an induction stove in the last year. And it wasn't like because I'm, really woke, or maybe I am, but I don't know. I don't even know what the word means anymore. But
I'm sorry, I have to reclaim my time only because I'm running out of it. And I do have one more question for you, okay? But I did want to say again on the issue of these price increases on insurance rates. These insurance premiums will rise for our constituents if insurance companies and their investors continue to bury their heads in the sand and fail to account for climate risk. We are already seeing a disturbing trend with some of the largest companies deciding to stop selling new policies and leaving people without insurance coverage at all. This is all clearly a result of climate change. It's not a question of whether it's going to happen, because it is already happening. And investors are saying they do not have a good sense of the climate risks that companies are facing. That is why it is critical that the government takes action. True enough, climate change is an existential threat. And I would argue so are the so-called leaders who deny that it is happening. Ms. Nagy, for the record, will disclosures for financial and business risks associated with climate change, like ESG, strengthen our insurance market and help families protect their homes?
Yes.
Thank you, I agree. And I yield back.
I thank the gentlewoman, and I now recognize myself for 5 minutes for questions. We wanted to have this hearing and talk about the dynamics in the market. Frankly, how do you accurately assess risk, and how do you price risk? It's clear that losses are getting more frequent and larger. When you think about insurance, you have to be able to price that in. It costs more money. It happens more often. How in the world don't prices go up? They have to go somewhere. If you look in California, they decided they were going to impose price controls so that you can't raise premiums. And also, you can't drop customers. So you go on site and you say, the gasoline stored in the outbuilding next to the pine straw next to your wood house is a risk. We'd really like you to mitigate it. No. And then the insurer still can't drop the customer? Are you kidding me? You have to be able to price risk. So part of the goal of the recognition of the ESG code that apparently is going to go out of fashion, if I listen to Larry Fink, just don't call it ESG, but we're still going to do it. They'll come up with a new label. It's a shape-shifting ideology. But the reality is we are dealing with more frequent and bigger losses, and a lot of those are looking at environmental places like California and wildfires, like Florida, where it's weather events, flooding, hurricanes, and in my state, more often it's tornadoes. But if you have to price that risk in order to stay in business, the alternative is things like the National Flood Insurance Program, where we have actually drafted bills we've had hearings on, and we're working to get towards a markup this year. But they don't have to make money, right? They don't, and they don't. They lose quite a lot. The federal government offers the flood insurance program because insurers can't really accurately cover all those things. So it is a supplement to the market, and the federal government is involved there. Terrorism risk insurance, another thing the federal government gets involved in. Overwhelmingly, a state issue. And I think the best thing to think about is housing as a state issue. You have different planning and zoning codes because, frankly, the risk of earthquake in California is bigger than Ohio. And we like the idea of building codes. We don't want things to happen in America like happened in Turkey because they didn't have big building codes. We should trust that our buildings are resilient for the area they're built in. But too often, when regulators decide that they're going to be the ones, central planners are going to decide instead of the market, they get it wrong. And they impose one-size-fits-all rules that don't accommodate all the flexibility that markets need. Prior to coming to Congress, I was in manufacturing. And for me to get the supply chain right, for me to design and build something, I needed some lead time. I can't turn, some things we can turn around quick, but some things take a little longer. So, Mr. Boer, when I think about manufactured housing, part of the way that we make it affordable is it's manufactured on site. All the planning and zoning for electrical and plumbing and whatnot can be done there, and it's regulated by HUD normally. Now we've got Department of Energy dropping in something that is not only hard to comply with on the timeline, but it disrupts the regulatory certainty that the industry needs. Could you talk about how that impacts your ability to deliver an affordable product?
Yeah, we're really uncertain where we're going to be heading from the requirements given two overlapping but very different regulators if the DOE process continues. And I want to be clear, I mean, we're not talking about not moving the ball forward on energy efficiency. We're talking about doing it in a holistic fashion where the impacts are thought through, and we can make great strides. So I think we're on a path right now where we're going after E at the expense of S.
Thank you. Thank you for making that point, and hopefully we can remedy it. Mr. Theodoro, when I think about pricing risk, you've committed a lot of work for it, and I just wonder if you could highlight some of the issues that we're confronting in the insurance space.
Yes, thank you, Chairman Davidson, for the question. Indeed, the price of reinsurance has risen in the January 1st renewals, the June 1st renewals, and the July 1st treaty renewals, and it's a major part of the costs of insurance policies after administrative expenses and claims is the cost of reinsurance, and it's getting higher. The good news is that there is capital out there that's coming in, private capital, pension funds, sovereign wealth funds, other asset owners.
I appreciate that, and I just have to get one more question in. But part of the problem for insurance is if you can't insure a site that you're going to develop, it's hard for builders to do it. And if you can't get the cover to provide for the market, briefly, Ms. Huey, could you highlight the challenge there?
Yes, thank you, Chairman. On July the 1st, FEMA halted parts of the mapping program under the National Flood Insurance Program. Home builders getting conditional letters of map revision and letters of map revision to prove that homes they built are no longer in the floodplain requires the home buyer to purchase flood insurance. By delaying this program for an indefinite period of time, we have a great fear that this will only increase the cost of homes. It's unclear how many future communities and homes.
I apologize, Ms. Huey. Thanks for getting as much in as you could. My time has expired, and really appreciate our witnesses for traveling, for being here, providing your expertise, and I thank my colleagues for spending some extra time understanding the impact on this issue. I hope it will inform future legislation, and with that, this hearing stands adjourned.